A recession is coming whether you like it or not. We don't know exactly when it will start, how bad it will be, or how long it will last. In this video, I will discuss 5 recession-proof stocks. If you're new here, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Before discussing the 5 recession-proof stocks, let's quickly cover what a recession is and why I think a recession is coming. A recession is characterized by a contraction in the economy. While some maintain that 2 consecutive quarters of falling GDP implies a recession, that is not entirely true. Last year, we saw negative quarter-over-quarter GDP growth, but other economic indicators were still strong. However, we are seeing a slowdown in the GDP. Another indicator is the yield curve. Economists look at the difference between a long treasury rate and a short treasury rate. Examples include 10-year treasury rates minus 2-year treasury rates, 10-year minus 3 months, or 10-year minus federal funds rate. When this difference is positive, the yield curve is normal. And when the difference is negative, the yield curve is said to have inverted. Every recession since the 80s has been preceded by an inverted yield curve. Typically, a recession follows a yield curve inversion within 18 months. When measured using the 10-year minus 3-month treasury rates, the yield curve has been inverted for the past 7 months. When you look at the difference between the 10-year and the 2-year rates, the yield curve has been inverted for the past 10 months. Both curves suggest an impending recession. Watch this video where I talked about the yield curve in detail. The unemployment rate is at 3.7%. Even though the unemployment rate is almost at its lowest in over 3 decades, and the initial unemployment claims haven't increased to levels seen before the great financial crisis or the dot-com bust, we are seeing continued unemployment claims tick up slightly. Employment data may seem like a positive, but try to understand the underlying implications behind the data. People have lost jobs, and they have been able to find alternative sources of employment. Still, at a reduced income, their spending power has diminished, and they are not going out buying expensive things or boosting the economy. The manufacturing PMI at 46.9% right now indicates an economic contraction for the past 7 months. This index measures economic activity in the manufacturing sector. A value above 50 indicates an expansion, and below 50 indicates a contraction. Services PMI is still strong, but is way below its peak from 2021, and the growth pace has slowed. The Confidence Board Leading Economic Index, or LEI, is down 4.4% over the 6 months between October 2022 and April 2023. This index includes 10 economic factors. Whenever the LEI year-over-year growth rate falls below 0, a recession has followed. All the data I discussed and more suggest an imminent recession, but nobody has a crystal ball and can guarantee what will happen. Let's discuss these 5 recession-proof stocks. But before I begin, I must remind you that this video is for educational and entertainment purposes only and does not constitute investment advice. I'm merely providing my personal opinion about these companies. Before making any investment, you must do your research. Every investment has a risk of potential capital loss, which means you could lose money. While dollar cost averaging using indexed funds discussed in this video is ideal for most investors, some of you are keen on investing in individual stocks, and this video is for you. My first stock is Johnson & Johnson. Johnson & Johnson manufactures and sells various products in the healthcare field: baby products, Tylenol, cold and flu medication, Benadryl, Pepcid, and so on. The three main segments are pharmaceuticals, medical devices, and consumer products. Even in a recession, people continue getting sick, and J&J will always have a market for its products. The revenue of this company has been stable over the past 5 years, and the company has continued to enjoy stable margins. Its EBIT margin has been in the 24 to 27% range. The company has had a strong return on equity. The short-term liquidity measured by the current ratio is at or above 1. The one thing I am concerned about is the debt coming due this year. J&J has about $18 billion, 34% of its total debt due this year. The average interest rate of non-current debt is less than 4%. Still, if J&J has to refinance this current debt, it will likely incur higher interest expenses because of higher interest rates, which will affect its bottom line. All stocks fall during a recession. However, the beta of this stock, which measures its volatility against the market, is 0.53. A beta less than 1 indicates that historically, this stock has been less volatile than the market. If the market rises, this stock is likely to grow less compared to the market, but you also get some downside protection. The stock has a dividend yield of about 3%. J&J represents about 1% of the S&P 500 index. The next company is United Health Group. They are one of the largest health insurance providers globally. Their three other business segments include Optum Health, Optum RX, and Optum Insight. If you have an HSA plan through United, you may be familiar with Optum Bank, which is part of Optum Health. Regulatory concerns pose some risks to this company, but overall, this company has a stable outlook for the next 10 years. If you look at its margin and profitability, both have been strong historically. The current ratio, which is the ratio of current assets to current liabilities, measures a company's liquidity to fulfill its current obligations. A good ratio is supposed to be greater than 1. However, in the case of United Health Group, this ratio has been stable. I would have been more concerned if this ratio had declined over the years. With a beta of 0.68, this stock is less volatile than the broad market, and the stock has a dividend yield of 1.4%. While the valuation is not cheap, the forward PE ratio is significantly down from its 2022 peak. UNH represents about 1.3% of the S&P 500. Before we move on to the next company, don't forget to like this video and share it with your friends. And if you haven't already, please subscribe to my channel with notifications. The next company is Procter & Gamble. They manufacture many products you already purchase: Tide detergent, Bounty kitchen towels, Dawn, Gillette razors, Pantene shampoo, Crest toothpaste, Always feminine products, and Pampers diapers. People will continue using these products whether the economy is booming or in recession. P&G has enjoyed stable margins and a solid return on equity. The current ratio has declined slightly. P&G has paid dividends for 133 years and its yield stands at 2.5%. The valuation is pretty high, so the upside is limited. However, this stock has a beta of 0.39, which means the downside is relatively low. P&G has a 1% weight in the S&P 500. The next company is Walmart. I don't need to tell you about Walmart. You know they operate discount stores. With the high prices and a looming recession, where will consumers spend their money? At a high-end store or a discount store? Walmart has a beta of 0.49 and a dividend yield of 1.52%. Walmart is a low margin volume business, but the margins have been stable and so has the current ratio, which indicates liquidity. Walmart makes up about 0.6% of the S&P 500. Valuations are high, so again the upside may be limited. The next company is NiSource. It is a utility company operating in northern Indiana, Ohio, Pennsylvania, Virginia, Kentucky, and Maryland. Utilities are considered defensive stocks because people still need to pay for utilities regardless of the business cycle. NiSource enjoys stable EBIT margins. Utilities tend to have high debt to equity ratio. With a beta of 0.47, NiSource has been less volatile than the broad market and currently has a dividend yield of 3.65%. NiSource makes up about 0.03% of the S&P 500. Typically, consumer staples, healthcare, and utilities are considered recession-proof sectors. They may not always yield a significant upside, but may give you some downside protection. Having said that, index funds are a much superior alternative if you don't have the time to research individual stocks actively. With broad market index funds, you get a well-diversified portfolio for the long term. With individual stocks, you have to be right 2 times. Once when you buy the stock and again when you sell it. Pay attention to your allocations if you want to invest in individual stocks. Evaluate your portfolio not just in terms of returns, but also in terms of risk. I mentioned percentages of the 5 stocks I discussed in the S&P 500. Those percentages are not huge. Follow the stock's news, but invest for the long term and don't get jittered by short-term price movements. Finally, the factors I discussed are not the only measures to use in your analysis. So get in the habit of thorough research before investing. If you found this video valuable, please share it forward and like this video and subscribe to my channel if you haven't already. Your love keeps me motivated to create great educational content for you. Let me know in the comments what else you want to hear. And as always, don't forget to be happy, to be kind, and to be your best self. I'll see you in the following video. Bye.